So, John, I don't know the answer to this question. I'm glad you're here because let's say, this is kind of a crazy topic, but let's say if you've stopped paying all your bills, the bank is about ready to foreclose, you haven't paid your insurance, you haven't paid your taxes, and your home burns down, what happens? Are you responsible for that? Who's responsible for it?
There are a few different ways to pay for insurance when you have a mortgage. One is through an escrow account, which means that it's mortgagee billed, which means that the mortgagee pays the insurance and puts that bill back onto your mortgage payment, basically. So the bank is paying the insurance up front each year, and as you're making your mortgage payments, you're paying them back for the insurance that they bought. So that's one way. The other way is if you don't escrow insurance and you pay for it yourself. Now, under the first situation, let's say you escrow in your insurance and your home goes into foreclosure. You haven't been paying your bills, but the mortgage company did pay for the insurance for the year, presumably. So you have a policy in force still. Even though you haven't been paying your mortgage, the bank has paid for the insurance. So the insurance is in force. If you were to pay your insurance separate from escrow and you stopped paying your insurance bills, which is very likely if you stopped paying your mortgage, that means that you don't have insurance on the property for at least some period of time. Typically, the bank will stay on top of this and they'll want to check to make sure that you have homeowners insurance as part of the requirement for the mortgage.
Sure. They can actually foreclose on you if you don't.
Absolutely. And so if you don't have homeowners insurance on your property, the bank tries to stay on top of that and make sure that there is insurance in place. If they find out that there isn't insurance, you get what's called force-placed insurance. If you make no effort to get your own insurance, you don't have any insurance on the property, the bank will give you force-placed insurance, which you have no say in the cost or coverages on the policy. So in most cases, force-placed insurance, you get less coverage for a much higher rate. And it's really just basically a simple insurance policy that's going to cover the bank, and it's not going to cover you. It's basically making sure that if this house burns down, the bank's going to be able to recoup their investment. And that's about it, because that's all the bank cares about. However, there is a scenario in which you stopped paying your homeowner's insurance bill. It's out of escrow. The bank hasn't found out about it yet and hasn't purchased a force-placed insurance policy. And the house burns down.
What happens?
There's no insurance on the property. There's nothing to recoup to rebuild the house.
It's a total loss.
Total loss. It's a huge mess. It's a terrible situation. I would imagine.
Who's responsible for that if the bank has the mortgage? Because the bank owns that portion of the house.
Right. Everybody loses in that case. When you take out a loan, you're responsible for getting homeowners insurance for that property. So whether it's going to be through an escrow account or you buy it yourself separately and pay for it separately, you're still responsible for homeowners insurance. And then when it goes into foreclosure, that's still your responsibility. It's still, regardless of who sets up the policy or who's initially paying for it, the original owner of the house is still responsible for paying for the insurance.